We've seen all the major banks release their financial results in the past few weeks, and they continue to keep a firm hand on the tiller as they try to improve the quality of their loan books and contain impairments. With South Africa's economy expected to grow by less than 2% this year and competition that is increasing, growth will continue to be a challenge. But in studio with us to talk about this week's cover story is Finweek's journalist, Jana Marais. Jana, thanks so much for your time. Economic headwinds that the banking sector is currently facing.
Yes, I think low growth is one of them. I think also the low interest rate environment is going to continue for longer than they thought. And low interest rates typically mean lower margins for banks. And don't ask me to explain the technical details behind that. But I think also, you know, they're really struggling still to get over that hangover of the 2000s. You know, when the world came crashing down in 2008, 2009, they're still struggling to get all those bad loans, and you know, so that's why they're much more disciplined about who they're lending money to. And you know, we saw things, banks like Absa, for example, their home loans, they've lost massive market share in the home loan space because that's an area where their fingers got burnt before the crash. So I think the challenge is to find these new areas of revenue. You can only increase bank charges by so much because you're in a competitive environment. So where do you find the new market opportunities? And obviously we've seen people go outside of South Africa to try and get growth.
So outside of South Africa, they are faced with increased competition. Another thing that comes to mind when you look at the banking sector is what is the outlook? If you look at the banking stocks on the JSE, they said retailers are overvalued. So the outlook for this particular sector?
I think it's been interesting to watch the results come in this year. I think, you know, the African growth story is phenomenal. They're getting massive growth rates elsewhere on the continent. But there's also a lot of risks involved. You know, you see countries like Nigeria and Angola, you know, where the oil price is really hammering those economies, commodity prices coming down. So banks are cautious. And even though it's fast growth or high growth markets, the overall contribution to their results are still minute, really. I think some banks have been doing really well. Standard Bank have managed to turn around their African operations. They're finally making money there. So it will be an interesting space to watch, but it's certainly not the only solution. You know, they will have to find other areas to improve efficiencies. I think they'll be pushing their digital platforms a lot more. It will be an interesting space to see. I think, you know, if you look at companies like First Rand, where the share price have run quite massively over the last few years, you know, shareholders probably should be a bit cautious, but then it's strong cash flow generators, so you know the dividends will always come through. So it really depends on what you want as a shareholder.
Well, Jana, speaking about First Rand, they released their interim results this week, and CNBC Africa's Gugule Tuqele sat down with the company chief executive, that is Sizwe Nxasana, and started by asking him about whether he is happy with his legacy at the group after he announced his retirement last week.
I think I'm reasonably satisfied. You know, there's always a lot more to do and so on, but it is also important for the organization to have new energy to, you know, drive succession planning and so on. You know, for my part, you know, having been here for 9 years, I think is enough. You know, I've always maintained that I don't think it's a good idea for a CEO to be in a position for more than 10 years, especially in the kind of environment where I find myself. So it is time for me to go and do other things as well, but also allow new energy, new ideas to drive the organization forward.
We've seen the plan with regard to leadership changes being executed very smoothly. So I take it shareholders need not be concerned about the strategic direction of the company now that you're leaving.
I hope not, because, you know, especially maybe talking as a shareholder now myself.
Yes.
It is important that we recognize that we have exactly the right team that is going to take the company forward.
On the rumors that the RMB chief executive might be stepping down anytime soon, have you a response to that?
Well, we did, as part of the announcement that we made on Friday, indicate that Alan Pullinger, who is the current CEO of RMB, is going to be moving into a deputy CEO position at First Rand. We've started a process at RMB to fill the vacancy there.
Let's touch on your numbers. Overall, we saw normalized earnings up by 15%, dividend up 21%, and return on equity up by 24%. This is substantially a lot higher than some of your peers in the industry. What's driven the growth in the numbers, and is it sustainable?
Well, if you just look at the history, you know, what we've been able to deliver over the last couple of years, we certainly believe it is sustainable. There are a number of reasons for that. You know, if you look at our operating franchises, F&B continues to do quite well. They posted normalized earnings or profit before tax, you know, of about 16 or 17%, regardless of where you're looking at. You know, West Bank has continued to do very well considering the tough economic cycle, which affects the vehicle financing business particularly, growing their profits at 8%. And RMB, you know, growing their profits at 7%, especially in the context of the additional credit provision overlays that we created in recognition of some of the exposures that we have, especially in oil and gas in countries such as Nigeria. You know, that performance is a very credible, very solid performance. So our operating franchises are doing quite well. The number of things that we continue to do, we continue to focus on serving our customers, migrating customers to electronic channels, so that continues to be the case. Managing costs is always an issue, has been an issue over the last 6 years or so, and therefore the bottom line sort of is a sustainable level.